prefer buying puts over short selling stock because, while both are bearish strategies, the put purchase is generally less expensive and has less risk. The downside is that put options lose value due to time decay. This is not an issue for short sellers. Let's consider an example of a long put using the Dow Jones Diamonds DIA. In this case, the strategist is bearish on the market and expects a move to the downside in early 2005. The trading day is December 23, 2004 and the DIA is quoted at $108.15 a share. The strategist expects a 5% market correction during the first month of 2005 and sets up an aggressive long put play by purchasing 5 February 2005 DIA 105 puts for 80 cents per contract. Figure 6.1 shows the risk profile for the long DIA position with potential profit and loss values corresponding to underlying share prices. The cost of the trade is $400, which is calculated by multiplying the put premium per contract by the number of contracts and the multiplier of 180 cents times 5 times 100. The cost of the trade is also the maximum potential risk of the trade. Profits increase as the price of the Dow Jones falls. The maximum profit is equal to the strike price of the option minus the premium debit, multiplied by the number of contracts and the multiplier 100. In this example, the max profit is $52,100, 105 minus 80 cents times 5 times 100. The maximum profit will occur if the Dow falls to zero, which is not a likely event. Figure 6.1 DIA February long put risk graph. Source: www.optionetics.com. Platinum 95. Basic strategies using put options. The break-even is calculated by subtracting the put premium from the put strike price. In this trade, the break-even is $104.20, 105 minus 80 cents. If the diamonds fall to $104.20 at expiration in February 2005, the trade breaks even. There is no profit or loss excluding commissions. If the value of the diamonds falls below the break-even, the trader can bank a profit. Choosing an exit strategy for the long put depends primarily on the movement of the Dow. There are 3 ways to exit the position. The first is to let the put expire worthless and lose the premium paid to purchase it, which will happen if the price of the diamonds moves above the strike price of the long put at expiration. Obviously, this is not an ideal situation because the strategist has lost the entire investment. More often, the strategist will want to offset the trade during the life of the option. Offsetting the position involves selling an identical put option with the same strike price and expiration. If the market falls, the result will likely be a profit. If the market rises, the put can be sold to minimize any further losses. We generally recommend exiting a long put position at least 30 days before expiration because the final weeks of an option's life are when it experiences the greatest rate of time decay. In the DIA example, the strategist is expecting a 5% correction during the first month of 2005. Therefore, the exit will occur sometime in late January if the market does indeed turn south. At that time, the option will still have time premium remaining. For example, by January 23, 2005, the DIA had fallen to $103.75 and the February 105 puts were bid at $2 a contract. Therefore, the strategist could exit the position, sell the puts, for $2 per contract, which is $1.20 more than their initial cost. This translates to a 150% profit. Had the DIA rallied during the first month of the year, the puts would probably have little to no value and the trade would have resulted in a loss. The third exit strategy is to exercise the put option, which creates a short position in the Dow, assuming the trader did not already have an existing position in DIA. At that point, the strategist can hold the position or cover the short by purchasing the shares back to close the trade. Exercise makes sense when the time premium of the option has fallen toward zero and the put owner wants to unload shares or set up a short position. Most long puts, however, are closed through offsetting trades, which is the most common way to book a profit or a loss with almost any option strategy. In conclusion, the long put is a simple strategy that increases in value from a decline in the underlying security. Unlike selling shares short, there is no need to use margin. Perhaps the biggest benefit is that by entering a long put, the trader has limited risk to the amount of the initial premium. Similar to any long option strategy that results in a debit, the long put will suffer from time decay as time progresses. To minimize this situation, we recommend using options with at least 60 days until expiration. At the same time, we have large potential rewards as the price of the underlying falls, with the maximum profit occurring if the price of the underlying falls to zero. The protective put. One of the more basic combination stock and option strategies is the protective put. It is widely used and easy to understand. As the name suggests, the protective put is designed to protect a long position. Let's assume an investor owns 100 shares of Microsoft MSFT and is worried that holiday sales of the latest Xbox will not meet expectations. This is a short-term bearish scenario for the stock. That same investor can buy put options on Microsoft as a way of protecting the value of his or her holdings. When establishing a protective put, the strategist generally buys one put for every 100 shares. Let's consider an index example of the protective put using the semiconductor HOLDRS SMH. It's October 24, 2005, and the strategist is bullish on chip stocks and wants to take a bullish position on the semiconductor HOLDRs. However, during the past few months, the sector has been facing selling pressure and the strategist also wants protection in case the bullish prediction proves wrong. As a result, rather than simply buying shares, a protective put is set up by buying 100 shares of the semiconductor HOLDRs for $35 a share and buying one December 35 put for $1.25. The total cost of the trade is $3,625, 35 times 100 plus $1.25 times 100. The risk graph of the protective put appears in figure 6.2. Since the 96THE index trading course, bid and ask options are quoted using bid prices and ask prices. The BD is the price that the market is willing to take for the option. Therefore, if a strategist has a long put and wants to offset the trade by selling that option, the least he will get is the bid price. The ask or offering price is the price at which the market is willing to sell the option. If the strategist wants to open a long put or close a short put, the price he is going to pay is often the bid price. The difference between the bid and the ask is known as the bid-ask spread. Sometimes it is possible to get orders executed or filled within the spread, but this generally occurs only when another investor is attempting to create the opposite order at the same price or if the market makes a sudden move and the price quotes change. 97. Basic strategies using put options. Figure 6.2 SMH December Protective Put Risk Graph. Source: www.optionetics.com. Platinum. Trade generates profits as the stock price climbs, the curve slants upward and to the right. The break-even at expiration is equal to the strike price of the option plus the premium for the call. In this case, the trade breaks even at $36.25, which is the point where the shares can be sold for a profit of $1.25, offsetting the cost of the put. Above $36.25, the protective put position begins to make money. While the total cost of the trade is $3,625, the downside risk is capped by the long put. Since the option holder has the right to sell or put the stock for $35 a share, the most that is at risk is the put option premium of $1.25, or $125 per contract. In the protective put, the maximum risk is computed as the difference between the put strike price and the cost per share, plus the premium. It is important to note, however, that the protection is only good until December option expiration. At that point, the put expires worthless and the strategist can either 1. Hold the shares with no protection, 2. Buy another put, or 3. Exit the position entirely. The outlook for the underlying asset will determine the best course of action. Generally, the strategist will want to roll forward the put at least 30 days prior to expiration because the put will experience significant time decay during its final month. In other words, the put options used in the trade should have more than 1 month of life remaining if the strategist is concerned about time decay. 98. The index trading course. Rockin' and rollin'. Roll is a term used to describe a position adjustment. For example, rolling out an option refers to switching an existing option with a longer-term option for the same underlying. More specifically, if a strategist owns the September 35 call, the position can be rolled out by closing the September 35 call and buying a December 35 call. Rolling up occurs when the strategist substitutes a call option with the same expiration date for a call with a higher strike price. For instance, the strategist owns the September 35 call and rolls up the position by closing out the September 35 call and buying a September 40 call. Rolling down involves trading a put option for a put with a lower strike price. For example, if one holds the September 50 put, the position can be rolled down by closing out the September 50 put and buying a September 45 put. When does the protective put make sense in the index market? In our opinion, it doesn't very often. Why? Because the same risk graph can be created using a simple call purchase. Let's consider an example. In fact, we already have, in the previous example of the semiconductor HOLDRs. Instead of purchasing 100 shares, we purchase one December 35 call option. The risk curve of this strategy, shown in figure 6.3, is identical to the risk curve of the SMH December 35 protective put shown in figure 6.2. Since the protective put and the long call have the same risk graph, the strategist can achieve the same results with either strategy. However, purchasing one call option requires much less money when compared to buying 100 shares in one put. So, while the protective put and the long call have the same risk graph, the protective put requires a lot more capital. It is an expensive strategy. Yet, despite its drawbacks, some investors do use the protective put. Sometimes the trade is short-term. For example, if an investor holds a large position in one stock and is worried that shares might fall following an earnings report, he might decide to buy a protective put ahead of the news and then sell it the day after. The married put is a term used for a position that is created when the put and the underlying shares for the option are purchased at the same time. In addition, the strategist must intend to exercise the put in order for the put and the shares to be married. The status can be relevant in the tax treatment of the position, which is a detailed discussion that lies outside the scope of this book. Suffice it to say that the protective put can be established either on an existing position or as part of a new position. When it is part of a new position and is designated as a hedge or protection, it is considered a married put. 99. Basic strategies using put options. Figure 6.3 SMH December long call risk graph. Source: www.optionetics.com. Platinum. Cash secured put. By selling a cash secured put, the investor receives premium while waiting for the stock to decline to the strike or price at which he is willing to own the stock. The position involves selling a put option and depositing the money for the purchase of stock into the brokerage account. The money is often placed in an interest-bearing account such as a money market. The money remains on hand in case the put is assigned and the shares are put to the option seller. The buyer of the put will generally exercise the option should the underlying stock drop below the strike price and there is little or no time value remaining. If the stock remains above the strike price by expiration, the premium is retained by the seller and another put can be sold. The short put. The short or naked put strategy is another one that we don't find compelling. It has limited profit potential but can carry significant risk. The strategy is sometimes used in lieu of buying stock. For example, option writers might sell out of the money puts on the Dow Jones Diamonds if 100, the index trading course. They are willing to buy shares at the strike price, which is below the current market price. Naked puts are best used in bullish or trendless markets when the strategist expects the underlying asset price to remain above the strike price of the put option. The strategist receives the option's premium for selling the option. The premium is the maximum reward for a short put position. The losses can be significant if the price of the underlying asset declines in value and falls below the strike price of the put. Let's look at an example of a short put on the mini Nasdaq 100 index $MNX or MINX. The fourth quarter has been a historically strong period for tech stocks and the Nasdaq during the past few years, and the strategist expects this year to be no different. As a result, the strategist decides to sell at the money puts to bring premium into the trading account during the final 2 months of the year. The time is late October and the MINX recently printed at 155. The strategist sells 10 MNX December 150 puts and collects $1.75 per contract, or $1,750 in total. Figure 6.4 shows the risk graph of the naked MNX puts. The risk curve slants downward to the left since the trade loses money as the price of the MINX falls. Additionally, the profit is limited to the initial credit received for selling the put. When the underlying instrument's price rises and remains above the strike price of the put option, the strategist is in the profit zone. At these levels the options expire worthless and the trader can keep the initial credit received. Figure 6.4 MNX December short put risk graph. Source: www.optionetics.com. Platinum. The naked put is similar to the sale of calls because the strategist is selling options and bringing in premium to the account. The maximum reward is the premium received for selling the options. However, the position has a limited but high downside risk. The ideal exit for the naked put sale occurs if the underlying asset price stays above the put strike price. At that point, the strategist does nothing and can keep the premium, which is the maximum profit on a short put position. However, if the underlying shares reverse and start to fall, a loss might occur. We would recommend offsetting the position by purchasing a put option with the same strike price and expiration to exit the trade. If the position is not offset and the underlying asset falls below the put strike price, the put will be assigned to the put seller. For a stock, assignment involves the delivery of shares. For indexes, like in our example, assignment will involve the delivery of cash equal to the difference between the settlement value of the index and the strike price of the option. For example, assume that at expiration the settlement value of the MNX is 125. The difference between the strike price and the settlement value is 25. Therefore, the loss is equal to $25 per contract, or $25,000. $25 times 10 times 100. Obviously, the strategist is taking on a lot of risk for a relatively small reward. Given the high risk, limited reward associated with naked put selling, the strategy is not one that we use very often. The cash secured put, which is simply a way of entering a stock position at a lower price, is suitable in some situations when the investor wants to buy the stock at a lower price. It is no more risky than the covered call strategy discussed in Chapter 5. Nevertheless, the strategist will want to exercise caution because, while naked put selling can generate income over time, one bad trade can wipe out a large number of small gains. Instead, the strategist looking to sell puts should look for ways to mitigate some of that risk by using limited risk spreads, like the bull put spread. Bull put spread. The bull put spread is a credit spread created by selling a put and purchasing another put with a lower strike price and the same expiration. Like the naked put, the strategy works well in trending or bullish markets when the strategist wants to generate income from selling puts. However, unlike the naked put, the risk from the trade is much more limited thanks to the purchase of the long put. That is, if the underlying asset tanks, the gains from the long puts can offset some of the losses from the short put. The long put can also be used to satisfy assignment. Basic strategies using put options. 101. 102. The index trading course. The maximum reward of the bull put spread is limited to the net credit received from the balance between the purchase and sale of the puts. The maximum profit occurs when the market closes above the strike price of the short put option. At that point, both puts expire worthless and the strategist can keep the net credit. When establishing a bull put spread, we generally recommend using options with 45 days or less until expiration. This will provide less time for the underlying index to move into a position where the short put will be assigned. In addition, the time decay factor is key to the success of the bull put spread. The trade will generate the best results when the short put loses all of its value and expires worthless. Let's consider another example using the mini Nasdaq 100. Once again, the time is late October and the MNX recently printed at 155. The strategist sells 10 MNX December 150 puts and collects $1.75 per contract, or $1,750 in total. At the same time, the strategist will buy 10 MNX 140 puts for 10 cents a contract. The long puts are used to limit the potential losses if the strategist is wrong about the direction of the Nasdaq. Figure 6.5 shows the risk graph of the MNX bull put spread. The risk profile of a bull put spread slants upward from left to right, displaying its bullish bias. If the underlying shares rise to the price of the short put, the trade reaches its maximum profit potential. Conversely, if the price of the underlying stock falls to the strike price of the long put, the maximum limited loss occurs. Figure 6.5 MNX December bull put spread risk graph. Source: www.optionetics.com. Platinum. 103. Basic strategies using put options. The break-even occurs when the index price equals the higher strike price minus the net credit. In this case, the break-even equals 148.35, 151.65. This trade makes the maximum profit if the MNX closes at or above 150 at expiration. The risk profile displayed indicates a trading price of approximately 155.50 for the underlying with 57 days left until expiration. Therefore, the odds are good that it will remain above 150 and both puts will expire worthless. If so, the strategist will keep the initial net credit of $1,650. The maximum risk is still high relative to the premium received for the trade, but is much less than with the naked put. The maximum risk is equal to the difference in strike prices times the number of contracts, minus the net credit. In this trade, the maximum risk is $8,350, 150 to 140 times 10 times 100, 1,650. So the risk-reward ratio of this spread is not great. The strategist is risking $8,350 to make $1,650, a ratio of approximately 5 to 1. When looking for bull put spreads, we are generally looking for ratios of 2 to 1 or better, which is difficult to find in the index market but can sometimes be found in the stock market. Nevertheless, the point remains the same. Like the naked put, the bull put spread brings in premium when the strategist expects the market to move higher or trend above the strike price of the short option. However, the spread will limit some of the short put risk during a significant market decline. In sum, it usually makes sense to pay a nickel or dime for this type of insurance rather than simply selling naked puts. The price action of the underlying asset will determine the best exit strategy for the bull put spread. Since the maximum profit is limited to the net credit initially received, the ideal situation is for the underlying index to rise above the strike price of the short put and for both options to expire worthless. If so, the strategist does nothing and keeps the net credit. If the price of the underlying asset rises above the break-even, but not above the short put strike price, then assignment is a risk at expiration. The strategist will probably want to close out the trade rather than face assignment on the short put. However, at that point, the long put can be closed out at a profit. In the event that the price of the underlying asset falls below the break-even, the bull put spread will lose money. With stocks and ETFs, the short put could be assigned once it is in the money and close to expiry. If so, the strategist will buy 100 shares per short put, but can exercise the long put to satisfy assignment. Being assigned the short put and exercising the long put will result in the maximum possible loss. With index options, such as in Arming's example, the short put cannot be assigned until expiration because the options have the European-style settlement feature. Therefore, if the options are near the money or in the money as expiration approaches, the strategist will probably want to close out the spread rather than run the risk of assignment at the time of option expiration. Covered put. The covered put is not a trade we establish often, but is a strategy that is sometimes used in a bearish market. A covered put consists of selling the underlying and selling a put to cover the underlying asset's position. Obviously, it can't be applied to a cash index, but it can be used with exchange-traded funds like the QQQQ, diamonds, or SPDRs. The covered put trade can be risky because it involves short-selling shares. Meanwhile, the reward on a covered put is limited to the difference in the price of the short underlying asset minus the strike price of the short put, plus the credit received for the option premium. In this example, let's go short 100 shares of the Qs at $41.50 while simultaneously selling 1 February 2006 41 put for $1. The risk graph in figure 6.6 shows this covered put position. The break-even is simply the initial price of the underlying shares plus the premium from the short sale of the put. In this example, the break-even equals $42.50, $41.50 plus $1. At that price, the short position can be covered for a $1 loss, but the premium received from selling the put offsets that loss. The maximum risk is unlimited as the stock price moves above the break-even. If the Qs stay above the strike price of the option, the short put will expire worthless. However, as the price climbs above the break-even, the position in QQQQ shares will lose money. If the market continues to move to the upside, the risk is unlimited. The profit potential from the covered put is limited, and equals the difference between the initial price of the shares at the time the short position is entered and the strike price of the option, plus the premium received from selling the put. For example, if the Qs fall to $39 a share, the short put is assigned and the strategist is obligated to buy 100 shares for $41 a share. The strategist uses the shares to cover the short and that yields a profit of 0.50 a share. In addition, the strategist keeps the premium 104 The index trading course. What is pin risk? Pin risk is the risk an option writer faces when the price of the underlying asset closes at or very near the strike price of the option. It is an important factor in selling options because if the asset closes at or very near the strike price upon expiration, the option holder might exercise the option and the writer will be faced with assignment. Let the seller beware. 105. Basic strategies using put options. Figure 6.6 QQQQ February covered put risk graph. Source: www.optionetics.com Platinum. From selling the put and the total profit is $150, $50 on the short ETF sale and $100 from the put sale. If the price of the underlying asset rises, the covered put seller can run into trouble and the strategist will want to exit the position. If the underlying asset price is below the initial short sale price, but above the strike price, the short put expires worthless and the strategist keeps the premium. No losses have occurred on the short stock position and another put can be sold at that time. The profit potential begins to diminish as the price of the underlying asset continues to move higher. If it rises above the break-even, the short put will expire worthless, but the short shares will create a loss on the position. Therefore, strategists will need to be careful if the market rallies because the short side of the trade can result in sizable losses. For instance, if the Qs rise to $50 a share, the short sale of the shares will result in an $8.50 per share loss, which is only partially offset by the $1